What happened today in the silver market is something no one saw coming. Not the analysts, not the banks, not the traders glued to screens, and certainly not the brokers scrambling to make sense of the sudden volatility. One moment, the market was calm. The next, it was as if an invisible hand had ripped the floor out from beneath everyone. A single order had entered the system, massive beyond anything seen in recent history. $6 billion worth of physical silver, and no one knew who had placed it. This wasn't a routine purchase, a retail frenzy, or a speculative hedge. This was something far more calculated, something that only a player with enormous resources, precise timing, and insider knowledge could execute. The initial reports from dealers and vault operators described the order as surgically precise, engineered, and strategically disruptive. Systems froze, algorithms failed, and even the most experienced traders found themselves staring at screens that no longer made sense. The $6 billion number isn't just eye-catching, it's designed to be destabilizing. Large enough to cause a shortage in the physical silver supply, but carefully calibrated to avoid immediate public alarm. The move immediately sparked questions, and the speculation was dizzying. Was it China? A Gulf sovereign fund? A mega institution like BlackRock operating through dark pools? Or something even more secretive? Every scenario felt more dangerous than the last. The order itself wasn't simple. It didn't flow through standard exchange channels. It bypassed the usual custodial vaults in the US, routed instead through offshore brokers, private banking networks, and shadowed intermediaries. By the time algorithms flagged the anomaly, the move had already caused ripples across every corner of the market. Traders report that the order targeted physical silver specifically, not paper contracts, ETFs, or futures. And this is the key. The paper market, which dominates trading volume, is more than 200 times larger than the actual available physical metal. The system relies on the assumption that not everyone will demand real delivery. When someone does, the illusion collapses. That's exactly what happened today. Liquidity disappeared almost instantly. Dealers who normally provide price stability were forced to retreat. Deep market data indicated that the order was spread across multiple time zones, designed to avoid triggering standard trading alarms. The precision was remarkable. Buy blocks appeared during Asian hours when markets were thin, rerouted through European dark pools to disguise the buyer, and even in US trading hours, purchases were broken into multiple channels to avoid triggering alerts in the major ETFs. Even more concerning, physical silver inventories in major vaults are already low. Multi-year lows in New York, London, and Hong Kong mean that an influx of orders like this can create instant structural strain. Banks, miners, and industrial users all rely on a steady assumption of supply. When that balance is disrupted, prices spike violently, spreads widen, and the system's fragility is revealed. Some insiders are whispering that this move may be more than just a market play. It could be a signal of strategic positioning for geopolitical leverage, preparation for a major supply chain disruption, or even a hedge against a looming currency crisis. Whoever executed this nettle understands not just the metal markets, but the infrastructure, algorithms, and global trading systems that govern them. The immediate effect was chaos. Futures contracts saw unusual spikes in backwardation, the price for immediate delivery exceeding future delivery. This is rare, a classic sign of shortage panic. The silver market, which normally moves gradually, jumped almost vertically, and yet the mainstream media barely covered it. Today's hidden buyer didn't just buy silver, they removed it from circulation, creating stress in every layer of the financial system that touches precious metals. The ripple effect was instantaneous. Bond yields flickered, volatility indexes spiked, the dollar index hesitated, and paper silver contracts lost their usual correlation with physical delivery. This is the part no one is talking about publicly. The market isn't just reacting to the number, it's reacting to the knowledge that someone can manipulate physical supply at will, silently, and on a massive scale. Today's move exposed the weakness of the system and sent a clear warning. When a player this sophisticated enters the market, the rules change. As the initial shock settled, analysts started looking for clues. Cargo manifests, vault inventories, and unusual banking activity all pointed to a coordinated accumulation strategy. Even in the industrial sector, unusual procurement orders for silver-heavy components appeared in parallel, particularly in solar panel manufacturing, AI hardware, and EV battery production. This wasn't a coincidence. Whoever placed the $6 billion order knew exactly what they were doing, and the market felt it. Once the dust settled, the deeper story began to emerge. Analysts who normally monitor futures activity noted patterns that were impossible to ignore. Orders flowed like a shadow across global exchanges, leaving fingerprints only visible to those with deep access to trading microstructure. Asian markets carried the first blocks, taking advantage of thin liquidity. Europe processed the bulk without raising alarms, and U.S. markets saw fragmentation in every major broker channel. The goal was clear: avoid detection while exerting maximum systemic stress, and the impact was immediate. Options volatility exploded, bid-ask spreads widened dramatically, and collateral requirements spiked. Retail traders were caught off guard. Many who thought silver was just another commodity were suddenly forced to confront a reality they hadn't imagined. Physical metal is finite, and demand can be concentrated in the hands of one extremely powerful entity. The paper versus physical divide became obvious almost overnight. While ETFs and futures struggled to stay balanced, the physical market began to exhibit backwardation at unprecedented levels. The silver futures curve inverted, an unmistakable sign that immediate demand far outstripped future expectations. Deep backwardation like this only happens during extreme panic, as seen in 2008, 2011, and 2020. But this time, the driver wasn't retail hysteria. It was a coordinated accumulation. Traders in London, Singapore, and Hong Kong began reporting unusual activity in private banking desks linked to state funds. Shipment delays, abnormal buying pressure, and secretive offers from unknown buyers were all indicators that the $6 billion order was part of a long-term strategy. This was not speculation. This was strategic positioning. Physical silver inventories were being drained quietly, ounce by ounce. COMEX vaults in New York and London, Swiss storage facilities, and Middle Eastern allocations all reflected a sudden vacuum. Industrial users, meanwhile, noticed delays in deliveries for key production materials. Solar panel manufacturers were forced to reorder, AI and EV companies faced rising component costs, and refiners reported unusual requests for industrial-grade slabs rather than standard coins or bars. Banks were panicking behind closed doors. The realization was sinking in. If the hidden buyer continued, the entire system could experience a massive short squeeze. Prices wouldn't just spike temporarily, they could jump violently and remain disconnected from the paper market for an extended period. Sources who spoke anonymously revealed that the buyer's strategy had been months in the making. Deep monitoring of vaults, logistics chains, and industrial consumption allowed them to calculate the exact amount needed to stress the system without triggering a public alarm. Every step, every block of silver purchased was engineered to manipulate the market while staying invisible to most observers. The implications are staggering. If physical silver continues to be withdrawn at this rate, every layer of the financial system that relies on paper contracts becomes increasingly fragile. The illusion of stability disappears. Banks that were previously short on silver are suddenly at risk. Industrial users may have to pay massive premiums or face supply shortages, and geopolitical players are watching silently, knowing that such a concentration of a critical resource could shift balances in the real economy. Even more concerning, the timing aligned with unusual movements in Chinese vaults and exports. Withdrawals were recorded without corresponding deliveries, shipments were rerouted to the Middle East, and customs filings didn't match vessel capacities. This suggests an organized shadow operation moving metal in ways no casual observer could track. It's a perfect storm. Physical supply is low, industrial demand is high, and a single hidden buyer is manipulating the system with precision. And yet, the world outside the trading rooms remains unaware. Headlines ignore the real story. Prices reflect temporary movement, but the deeper structural shifts are invisible. Analysts call this a rare opportunity to observe market mechanics at their most vulnerable, but for most, it's a warning. Whoever controls this supply could dictate the silver market for months, maybe years. The lesson is clear. When a player this magnitude enters the physical market, the conventional rules no longer apply. By now, the world has felt the ripple effects of the $6 billion silver accumulation, not just in prices, but in behavior. Traders are adjusting strategies, industrial firms are stockpiling, and banks are recalculating risk. The sheer scale of the hidden buyer's influence is impossible to ignore. The $6 billion figure is more than a number, it's a statement. Whoever executed this order has both the resources and the patience to manipulate physical supply at will, silently and on a massive scale. They can stress delivery systems, create scarcity, and send signals to governments and industrial players alike. Every spike, every disrupted shipment, every widened spread is a message. Global supply chains are now on alert. Manufacturers reliant on silver-intensive components, from solar panels to AI servers, are recalculating demand forecasts and delivery schedules. Vault managers and bullion banks are quietly reviewing inventory and contingency plans. Slight miscalculations could have cascading effects across multiple industries.